Hey, what's up, stock compounders? Brad here. So it's been like 3 weeks since I uploaded a video. I was in Cape Cod for a couple weeks with the family, and I've been binging on Mohnish Pabrai content since I got back. There's like 3 Q&A sessions that I'm behind on. So in this video, I just want to share my highlights from the Brown University Q&A that Mohnish Pabrai did on August 2nd, just over a week ago. So let's jump in to my takeaways from that talk. First, Pabrai is asked about using mechanical filters to kind of screen for great potential investments. You know, the questioner mentioned a market cap less than 500 million. Pabrai has talked about that in the past as sort of a size limit on what he's looking for in terms of spawners under 500 million market cap. And the idea behind that is most companies don't make it to more than 50 billion market cap. Okay, it's pretty rare for a company to exceed that size. So, you know, if we can find opportunities below 500 million, there's a potential 100 bagger there. At least that's the kind of simple math that Pabrai laid out. So market cap less than 500 million. The other potential filter that the questioner mentioned was high insider ownership. Okay, and that's something that I use quite heavily, which I picked up from Chris Meyer, author of 100 Baggers. But Pabrai is asked, are there other mechanical filters you use? And he's kind of alluded to this answer in past Q&As. He says, anytime you mention to me mechanical filters, I cringe. Okay. And the reason for that, he says the real world is messy. Okay, individual businesses are messy. It's not very practical from Pabrai's perspective to use these kinds of mechanical, these quantitative screening filters, because businesses are just so different. You've really got to understand the nuances of each business. Next, you know, he talks about Tencent, okay? He's kind of talking about different types of spawners. And so he gets into Tencent. He says, inside Tencent is what I would call Sequoia Fund on steroids, okay? The cash flow that Tencent generates is plowed back into businesses, okay? Investments, mostly in private companies. And that's how Tencent is just able to generate incredible return on capital over time because they have, you know, they're very skilled at making these investments early on in the lives of these private businesses. Right. He says this engine that Tencent has is extremely rare. Okay, most businesses don't have the opportunities that Tencent has to reinvest earnings at those high rates of return. So, you know, it's an apex spawner, as Pabrai would say, with Tencent. He talks about Berkshire, okay, comparing Berkshire Hathaway to Amazon. Berkshire did not issue dividends or buy back stock for the first 40 years, okay? The reason for that is Berkshire had plenty of opportunities to acquire businesses that were more compelling from a shareholder value perspective than issuing dividends or buying back stock. So he mentioned they took the cash flow from Seas and other great cash flowing businesses and bought 100 other businesses. Okay, that was the business model of Berkshire Hathaway. Now, in the case of Amazon, the redeployment of cash generated is mostly done with internal projects, okay? So Amazon has all of these projects internally that they're plowing those cash flows into, and it's obviously worked incredibly well for Amazon. Again, a very unique DNA to be able to pull that off. The absolute best way to use capital is if you have a spawning engine internally that has a high hit rate, right? A lot of these projects work out. internally and is spawning businesses that generate high returns on equity. Okay, Pabrai calls this Mecca. That's really what Amazon has been able to do, which is even a step above Berkshire, that's had to rely more on acquiring external businesses to kind of keep it going. Second is if you can buy or invest in other businesses or assets at valuations that will give us high returns on equity. Okay, Berkshire fits into that bucket. The third is dividends or buybacks. But he does mention buybacks can be extremely powerful if they are done at modest valuations. Okay, so that's kind of the first part of the talk. He talks a little bit about China. And he describes China. In China, it is innovation and then regulation, okay? Compared to the US, where it's innovation and no regulation. So I think that's why it's easy to look at a company like Alibaba, a company like Tencent, and see what's happening in China, sort of the regulatory crackdown, and get scared about that. But Pabrai says, in the case of the large players in Chinese tech, they're pretty high quality players, but in many cases the rules were not defined, okay? So the government basically says, hey, let's see what you can do. And then once the companies are more mature, that's when the rules get made. The Chinese government coming down and saying, hey, wait a minute, I think some of these things, if we tweak it somewhat, at the end of the day, we will end up with a better ecosystem. I think that's what they're driving towards. Okay, so if you look at what's happening in China through that lens, I think it may be a little bit more palatable what's happening. It may help you understand why what's happening is happening from the CCP. Talks a little bit about payment systems in the US versus China, MasterCard, Visa. I'm not really going to get into that. Pabrai has asked, and I was excited that someone asked this question, how can investors running small amounts of capital generate 50% annual returns? I think it was like 10 years ago, maybe more. Buffett was asked, what returns he'd be able to generate if he were running small amounts of capital, say $1 million. And Buffett said, I'm sure I would be able to generate 50% annual returns. So Pabrai answers this by saying, it was really useful for me to set an absolute target, okay, when thinking about returns. I want to double my capital every 3 years. And of course, for those of us who follow Mohnish Pabrai, we know his license plate said COMLB26, compound 26. Because if you double your money in 3 years, that's a 26% annual rate of return. So if you have that focus, right, that's your target, double in 3 years, it takes a lot off the table. You're not going to be looking at businesses at 80% of intrinsic value, right? Because you're not going to hit that double in 3 years in all likelihood. Even with some growth, it's going to be hard to get that double. If you're able to buy an asset which is worth $1, but you can buy it for, say, 30 cents, maybe even 50 cents, that may lend itself to that target. Okay, so it's important to get very clear about what your target is, what your goal is, because that really drives the framework of how you invest. He talks about the range of assets that can give you that outcome vary a lot. Obviously, you can buy stocks, you can look at micro caps. Pabrai mentioned you can buy distressed bonds, high yield bonds. That's really where Howard Marks cut his teeth in that arena. Of course, he mentions most bonds where your coupon is 30% a year or 26% a year are that high for a very good reason, all right? You're probably not going to get your coupon payments, and you're probably not going to see your money at the end when the bond comes due. So you've got to know what you're doing, right? You've got to be able to analyze the business and make sure that your downside is protected. But some things get mispriced, okay? He mentioned Charlie Munger in 2002 bought Tenneco bonds at 20 to 30 cents on the dollar, right? So he invested about 10 million in Tenneco. I think that was both bonds and stock. And it turned into 80 million in 3 or 4 years. That's an 8x in 3 or 4 years. Incredible. I think right after that, Munger plowed that 80 million in with Li Lu and, did another 5x or something in a handful of years. So pretty incredible series of investments there for Charlie Munger. Greenblatt. So this is a very important point from Joel Greenblatt. And for those of you who haven't read Greenblatt's books, You Can Be a Stock Market Genius or The Little Book That Beats the Market, Greenblatt points out if you are extremely good at identifying opportunities that will generate 50% returns with $1 million, right, with that small starting amount of capital, it won't take long to end up with 10 million, right? If you're generating 50% annual returns, in 10 years, you turn, say, $10,000 into $600,000, okay? A 60x in 10 years if you're generating those 50% annual returns. So small amounts of money become quite large amounts of money very quickly with returns like that. So if you are getting those 50% returns, it's not going to be long at all until you end up with 10 million, 20 million, 50 million. And then you're going to be looking for other opportunities, right? You're no longer going to be looking for those small opportunities that fit into the kind of $1 million bucket. You've left the arena of the $1 million opportunities because they no longer move the needle, right? I mean, the most obvious example to think about is Warren Buffett. How little he can look at in terms of public companies that will move the needle for Berkshire Hathaway. I mean, Berkshire is what? It's like 600 billion, okay? Market cap. So he really needs to find companies that are 600 billion or larger, right? Because if he wants to invest a 10% stake, of course, Berkshire doesn't invest many 10% stakes anymore because there's so few opportunities like that. I mean, very limited by size. So that's the beauty of this game. Investors who are really good with small amounts of capital, they leave the arena of the very small businesses, these micro cap opportunities, which opens it up to new entrants. That's really Pabrai's point here. So to sum that up, where is it? Well, I'll just keep going. I manage around 750 million now. This is Pabrai talking about Pabrai funds. When I find opportunities where the total capital I can invest is only $2 million, I don't spend my time looking at that business. It takes effort to dig into a business, regardless of the size, right? To really understand a business. So it's just not worth Pabrai's time to figure out those smaller businesses that aren't going to move the needle. This is what I wanted to find. As investors get more and more successful, they move up the chain, right? In terms of the size of businesses that they're looking at. And they leave the low end, the small businesses, to new entrants, okay? So the low end is always there for a young, enterprising investor. That's kind of the beauty of this game. If you've got hustle, there's always going to be opportunities in the small businesses for investors managing small amounts of capital to do really well, right? There's going to be a lot more mispricings in those smaller opportunities because there aren't as many experienced investors, turning over the stones in that space. When Warren Buffett was a kid, he used to go to the Ak-Sar-Ben racetrack. What is Ak-Sar-Ben? Okay, it's Nebraska spelled backwards. It's a horse track. Buffett would go with I think it was his aunt, and he would collect all of the tickets that were on the ground after the race was over, okay? And the reason he did this, he figured, there's a lot of drinking at these racetracks. people are going to be throwing away winning tickets on accident, right? If I pick up all of these tickets on the ground, there are going to be some winning tickets. So that's what he did. He went on the ground, picked up all the tickets, went through one by one to see which ones were winners. And of course, he wasn't old enough to be able to redeem the tickets, right? So he had his aunt redeem the winning tickets and collected the money from those. So when Buffett became a value investor, he sat down with a Moody's manual. He did the exact same thing, okay? Starting with the A's, he went through the Moody's manual. He was looking for those winning tickets that investors had thrown away, okay? You know, an insurance company, for example, where the market cap is 15 million and 1 year of earnings is 25 million, all right? Opportunities like that. It was the same game he was playing. The game he started playing as a kid at the Exarban racetrack. And the whole point of this is there's always going to be winning Exarban tickets on the ground, right? At the racetrack, in the stock market. The question is whether you will make the effort to pick them up. You have to want it bad enough. Warren Buffett was maniacal about finding all of the winning tickets, both at the racetrack and in the stock market. So if you have that level of determination, you're going to figure it out. You're going to make it happen. And Pabrai quotes some, religious text here. Your deepest desire is your destiny. Okay. Buffett really wanted to find every single winning ticket that anyone had ever thrown away. He went all in on that. So if you're willing to go all in and search in the nooks and crannies of the market, you will find lots of treasures. But you must be very passionate about it. If you are focused, it will happen. So Pabrai mentions we cannot rely on quantitative screens alone. He mentioned that before. When we find things that are statistically cheap, it's only the beginning of the hunt. So this is really what Buffett was doing in the Moody's manuals. He was looking for companies that seemed cheap, right, on the surface based on some of the quantitative factors. That's the beginning, okay? And then you dig in. The first question after that is this within my circle of competence? Can I figure this thing out? So that's just goes from there. So he was asked, what would be your advice to someone who wants to start a fund? Okay, and this is a question Pabrai has gotten a lot lately. He said, well, before you ever think about starting a fund, what should have happened before you think about that is 10 years of 50% per year, okay? You should already be independently wealthy before you think about starting a fund. Because if you aren't, you haven't proven to yourself or your investors that you can do this. Like I mentioned before, 10,000 at 50% per year turns into 600,000 after 10 years. So if you know how to generate those high rates of return, if you've figured that out, you're going to be wealthy very quickly. So, and you don't need to start a fund, right, to get wealthy. A lot of people start a fund because they want to get rich through, the fees that are charged, the performance fees, sometimes even the fees for breathing, right, the 1 in 20 or the 2 in 20. But Pabrai thinks, that's not really the way to go about doing it. Makes sense why he says that. If you've done well, people will find you, okay? If you're generating 50% annual returns for 10 years, you don't need to start a fund and wave your flag and try to find investors. Investors will find you, okay? There's so much money out there looking for great returns. So just focus on generating those high returns over 5, 10, 15 years. The rest will take care of itself. Let's see. Lastly, Pabrai mentions a book that he's reading right now, which I just started listening to on Audible, called Invent and Wander. And it's based on the writings of Jeff Bezos, who needs no introduction. And Pabrai mentions business biographies and business autobiographies are probably his favorite genre. There's just so much to glean in terms of investing, learning from great entrepreneurs what their journeys have been like, which reminds me of the Nick Sleep. It's actually not Nick Sleep. I think picked it up from 100 to 1 in the stock market by Phelps, and that is the best investors aren't investors; they're entrepreneurs that never sold. So I'll leave you guys with that quote. Hope you enjoyed this. I've got 2 more highlight videos coming out. There's a Q&A from the 1% show. And then what's the other one? I don't even remember. I think it was sometime in mid-July, so I'll have that out shortly as well. But hope you guys enjoyed this recap of Pabrai's talk at Brown University. It was a great talk, and more to come. All right, guys, good to be back. See you all very soon. Bye.